Hello, this is Utkarsh Jain and we are on to the part 3 of our 60-minute guide to accounting. Now, what we've already seen till now is we first understood what was the meaning of accounting, then we understood that what was the meaning of transaction, then we saw that which all major financial statements that we have, that is we have balance sheets, we have income statement, and then we have a statement called as cash flow statement. Now after that we tried to classify certain items into various categories. So we saw that rent was an expense and rent received was an income, and in the process we understood certain vital and important concepts such as accrual concept, which said that the amount of cash paid or cash received is not important. What is important is the amount of expense incurred and the amount of income earned. And we also studied a concept called as the business entity concept, which said that owners of the business and the owner are separate legal entities from accounting point of view, and that is precisely the reason why that capital invested by the owner, which is his own money, on a business's balance sheet would be shown on the liability side. So now the time has come where we would try to put all this knowledge together, and using all this knowledge we'll actually start preparing balance sheets for the organization. Now the process that we are going to follow is completely different from the way accounting is generally done into colleges or into schools. We are not really going through the process of journal and ledger, and we probably see the meaning of these later on. What we are going to do at this stage is that from the transactions, we would directly start preparing balance sheets and profit and loss accounts so that we get good idea of the big picture, that how the accounting is done in real life. So let us start. We are going to have a set of transactions. The first transaction is started business with capital of $100,000. So now let us prepare our balance sheet, and this is how our balance sheet is going to look like. It's a simple box which is going to have two parts. The first part of the box would be called as liabilities, and the next part of the box would be called as assets. And then of course we are going to have amount and amount here, which means all the assets we are going to write on the right hand side, and all the liabilities we are going to write on the left hand side. Now why do we need to have liabilities on the left and assets on the right? There is no specific rule regarding this. So this is the convention that we follow in India. The convention might be different in different countries. That means you might encounter a balance sheet where liabilities are on the right hand side and assets are on the left hand side, but it doesn't matter because the logic remains exactly same. So now let us start putting these entries into our balance sheet. First transaction, started business with capital of 100,000. Now what we've already studied is that capital was the liability of a business using a concept called as business entity concept. So let me write down capital on the liability side. Capital amount is 100,000. Now there is one more concept in accounting, and that concept is called as double entry system. So what does double entry system mean? It means that every transaction is going to have two effects. Every transaction is going to have two effects of equal amount. So what does it really mean? It means that if I have to think from the perspective of business, when it received this 100,000 from the owner, it incurred a liability because it needs to pay back that amount to the owner, but simultaneously it also received that cash, and that cash that business has received is nothing but an asset for the business. Therefore the same transaction now I'm going to write down twice. First, capital $100,000, next cash, which is an asset for the business, $100,000. And now what we can clearly see is that the total of liabilities and total of assets is same, which is 1 lakh or 100,000, and which is very obvious because we wrote down the same amount twice, one on the left hand side, one on the right hand side. So the total of both the sides has to be same. In accounting, we call this as tallying the balance sheet. So let's post the entry number 2 now, transaction number 2. Next transaction is that we've taken a bank loan which is $300,000. Now bank loan for a business is going to be a liability. So let's write down bank loan on the liability side. Bank loan 300,000. Now that when a firm incurred liability of $300,000, simultaneously it also received that cash of 300,000, and therefore that cash balance of an organization is going to increase. So originally we had 100,000, now the cash is going to increase by 300,000. That means the total cash now is going to be 400,000. And now if you take the total of your liabilities and total of your assets, it is going to be 400,000, 400,000. That means that balance sheet is getting tallied. So now what we can clearly observe is that balance sheet gets tallied after each and every transaction. Let us do transaction number 3. Purchase of building $200,000. Now what is building? We saw that a building is going to be an asset for the organization. So let us write down building here. Building amount is going to be 200,000. Now the second effect of this transaction is that we've received an asset, so our assets have increased, building 200. But to purchase this building, we must have paid some amount in cash. That means now our cash is going to reduce. So we had $400,000. Now the cash is going to reduce and it will become $200,000, because to purchase building we need to pay cash. So now if I take the total of my asset side and total of my liability side, the total of assets is going to be 400,000. The total of liabilities is again going to be 400,000, and balance sheet tallies. Now why balance sheet would tally? It was very logical that every time we added some amount here, we added some amount here. And if we added some amount here, for example building, then to give second effect we reduced the cash. That means we made sure the total of the asset side was same. So this is the reason why balance sheet would tally from a mathematical point of view. From a logical point of view, these liabilities in accounting at times are also called as sources of funds, and these assets in accounting are also called as application of funds. Now if you see that what all sources does this business have, that business has got two sources of funds. That owners of the business have invested that money into the business, which is being called as capital, which was 100,000. Business also took a loan from the bank, which was 300,000. That means the total sources that the business had was 400,000. And where did I apply that sources? It applied those sources, half of it into building. So they used 200,000 to acquire the building, and remaining amount has been kept in cash it is. So my sources are 400,000, application is 400,000, and sources of funds and application of funds has to match each other. So it can never happen that you have more sources and you have less application, or it can also not happen that you have more application and less sources. So this is how balance sheet is going to tally. Now one final point that we will give heading to our balance sheet, we would say balance sheet as on a particular date. So let us say that 31st December 2012. Now this as on word is really important. What does it mean? It means that this balance sheet is true only on this particular date, which is 31st 2012. If I have to prepare a balance sheet on 30th of December 2012 or 1st of January 2013, the balance sheet is going to be different, which is very obvious that the moment there is an extra transaction, it is going to change the balances of these assets and liabilities. Therefore, balance sheet is always true as on a particular point of time, as on a particular date. Now, this balance sheet was a very basic balance sheet. We did not really prepare income statement along with this because there was no transaction which was of revenue nature. So now let us prepare one more balance sheet where we'll have some transactions which would go into our balance sheet and some transaction which would go into our income statement. So let's start. The first three transactions are going to be exactly same: business capital, bank loan, and purchase of building. So let's quickly prepare our balance sheet now. It is going to have two sides, liabilities and assets. We'll try to ignore the formats, not so important at this stage. And we will now also prepare one more statement which would be called as income statement. So on the left hand side of income statement, we would write down expenses. On the right hand side of income statement, we would write down income. Now balance sheet, what we studied is true as on a particular point of time. Income statement is generally prepared for the year ended or for the period ended. That means income statement is true for that particular 1 year or 6 months period for which we are preparing income statement. Now let's quickly post the entries. Capital, it was to be posted on the liability side. So capital 100,000, so I'm going to write down only 100 here. Second effect, cash is going to increase, so cash 100. Bank loan was 300, so bank loan 300, which is going to increase your cash, so now cash is 400. Purchase of building 200, building is an asset, so building 200. Now it is going to decrease our cash, so now cash is 200. Now let's give effect to next transaction, which would be total sales made during the year 300. Now what we've already studied is that sales is nothing but income of an organization. So we will go to the income statement on the income side and we would say sales 300. Now what should be the second effect of this transactions? That when we've made sales, it is very obvious that we are going to receive cash. Therefore, we are going to say that second effect is to add 300 to our cash, so that our cash will now become 500. We give two effects: one, sale on the income side; second, that we added that 300 to the cash, so now cash has become 500. Now let us try to take the total of balance sheet now. This side the total is 400 and this side the total is 700. That means the balance sheet is not really getting tallied at this stage. And what is the reason? The reason is that there is some item that we have on our income statement and the effect of that item needs to go to the balance sheet. So what does it mean? Let's assume that the business stops here for that particular year. There are no transactions after this. In that case, what we would say is that expenses are 0 but income is 300. That means the profit of the business is 300. And what we studied during our business entity concept is that if the profit is 300, that profit needs to be transferred to the balance sheet liability side. So if I have to write down this profit here of 300, then the total of this side would be 700 and total of this side would be 700. And then we would say that balance sheet has tallied. But let's not do it now because there is one more transaction that we have to give effect to. So let us go and see the transaction. Transaction number 5, total expense made during the year $100,000. So expenses 100, and the second effect is that since we have made an expense, our cash is going to reduce. So now our cash is 400. And now once we have posted all the entries, we will find out that what is the total amount of profit that we have. Total sales are 300, expenses are 100. That means the amount of profit is going to be 200. And this amount of profit needs to be transferred to the balance sheet liability side. We generally call transferred profit as reserves. So I would write down reserves and the amount of transferred reserves is going to be 200. And then I'll take a total of both the sides. The total would be 300 plus 200 plus 100. Total would be 700. Sorry, total would be 600. And total on this side is going to be 600 and our balance sheet tallies. So again, going to the same view, that if I say that liabilities are nothing but sources of funds. Now sources of funds to the business are 3. Number 1, amount invested by the owner of the business. Number 2, bank loan taken. And number 3, reserves. So the total funds that business has collected are 600. And how has this fund been applied? So application of funds. Out of the total funds of 600, 200 have been applied with building and remaining 600 have been applied with cash. So with this, we come to an end of our part 3 of 60-minute guide to accounting. I'll see you in part 4, where we'll do some level of advanced accounting and we'll increase the level of difficulty of our transaction so that we get in-depth view of how the real life accounting is done. Thank you very much. I'll see you in the next video.